That's always helpful for me. So yeah, if you can let me know, I'll keep an eye on the chat box, and again, we'll give it a minute or so for people to come in. So just to explain very briefly at the moment what it is that we're going to be covering. So again, just to give a little bit of an intro before we officially get started. We are doing swing shots today, which would hopefully, clue is in the name there, that what we'll be doing is we'll be looking at swing trading. That's what we're going to be doing, swing trading. So there we are. So swing shots means we're going to be looking at swing trading, which means the timeframes that we're going to be using are going to be daily charts and 240-minute charts for our bigger time frame, for our altered climate. And that means that we will be using 55-minute and 21-minute charts for our smaller timeframes. Now, it might be that we don't have enough opportunities on these timeframes, and so we'll have to look at different ones and maybe look at position trading or look at something a little bit smaller. But for the time being, this is the timeframes that we're going to be focusing on. And that's kind of what we mean by swing trading, right? Is to be looking at sort of middly timeframes that allows our trades to last for maybe a few hours, could be a few days. So that's what we're going to be looking at. Now, the good thing about this is you might be watching this thinking, but I'm a day trader. I day trade Forex, or I use Forex for investing long term. Great, you can use the exact same process, the exact same technology, the exact same methodology that I'm using. All you're going to do is change the timeframes. So instead of a daily, maybe you use a monthly, or maybe instead of a daily, you use a 60-minute. Or whatever. So you'll change the time frame to suit your style better, but the methodology will be the same and the use of the technology will be the same. So that's helpful. Okay, so just a quick intro then. So my name there is Becky. You can see that if you turn your head to the side. My email address is becky@tradewithufos.com. We then have tradewithufos.com/Becky. That's where I would like you to go to ask questions if possible. Of course, you can email me. I have no problem with you emailing me. It's just if you go to that link, which is tradewithufos.com/Becky, and you get yourself a free membership, you can then come down here and ask a question in a public space, which means others can then see the answers. So it means we can all learn from each other. I'm sure if you have a question, somebody else might have a similar question. So it means that later down the line, rather than email and maybe wait a day or two for a response, you'll have the answers here to obviously frequently ask questions. So that's where we prefer that you ask questions, which is tradewithufos.com/Becky, get yourself a free membership. But of course, like I said, you can email me if you have them. Okay, so just need to cover the disclaimers. Let's put those up on the board there. Of course, it's important that you guys read them, not just for legal purposes, but it's important to understand that when we do these kind of sessions, whether it's on FX Street, whether it's on YouTube, whether it's Forex, futures, stocks, it is important that you guys understand that we are giving you a demonstration of how we use the products, a demonstration of how we apply the methodology. Ultimately up to you, whether you ignore it completely, whether you use it, whether you combine it with something else, whether you trade it on a live account or simulate it or not at all. That's ultimately up to you, but hopefully you get a good idea from the demonstration as to how we do things. Okay, so let's move on to looking for opportunities. So we're going to come to TradeStation first. So we come to TradeStation first because TradeStation is very useful in a lot of ways. One of the main reasons that TradeStation can be useful is using our scanners. So rather than filter through 10, 20, 30 different currency pairs and figuring out whether or not they're a good opportunity, we can use our scanners to kind of save our time a little bit here. So our scanners will be highlighting to us these yellow boxes that are telling us we have near opportunities. That's what those yellow boxes mean. Now you might notice that some of these yellow boxes say sensible, so near sensible short or near sensible long, and some of them say hopeful. Now as traders, we want to make sure that we are trading sensibly, not hopefully. So we will only be looking at the ones that say sensible, so we can kind of rule those out. There's then another element here as well that we need to look into, which is this column here, same over here. We want to look for the currency pairs on this scanner that have, again, near sensible short. So these yellow boxes that say near sensible, either short or long. And we also want to make sure that the box in this column is colored. So whether or not it's red or blue, as long as it's not gray. If it's gray, we ignore that. So those are the things that we're looking for here. We're kind of scanning through the scanner to then, again, make it easier for us to go and have a look at these opportunities. So let's take, for example, let's go down here. So let's look at the Euro Aussie here. So at the top here, we see we have a yellow box that says near sensible short, meaning that if we have an opportunity that's near, it's not going to be so much of a waste of time to place a trade and then maybe wait ages for it to come in. And by the time it maybe comes to trigger, conditions have changed, we need to cancel it. If it's near, then it's likely that if we put it on, we'll get triggered soon. Of course, we still might not, but it's more likely. And we have a red box there, which tells us we have a confirmed downwards climate. So that means we're going to go look at the Euro Aussie. So let's bring up a chart. And we're going to put in Euro Aussie on this side. And by the way, I'm just using TradingView. I'm sure you guys probably use it. It's very widely used. If you use other platforms or other softwares, let me know. But hopefully you'll get it as I'm using TradingView. You could use TradeStation as well to do your analysis and then place trades through TradingView or place trades through another platform or broker. The good thing about TradingView is you can link it to whatever broker you want, pretty much, most of the common ones, which means if you place a trade through TradingView, it will route through the broker that you want it to route through, however the commissions go or however you like to fund that account. Now, at the moment, I'm using FXCM data. It could be Oanda data, it could be whatever. I literally just clicked the top one. I just wanted to make sure that I have FXCM on both charts. So don't worry if you're thinking, I trade Oanda and it's slightly different. You'll have, again, maybe slightly different numbers, but more or less it's going to be pretty much the same. Okay, so the first thing we want to be looking at when we're looking at our opportunities is our auto climate. That's what we have down here. So this is a free app, by the way. So if you have a free membership, which you can get through there, tradewithufos.com/Becky, get yourself a free membership, then you can download our auto climate app for free. What the auto climate app is doing is looking through the markets, analyzing the data, and coming back with these different colored dots that are either thick or thin. And then those dots will give us an idea of whether or not we have probability up or down or nowhere. So in this case, if we have a thick red dot, that tells us we have a confirmed downwards climate, probability to the downside. That's not to say we're just going to go and press sell. That would be kind of silly, but it is obviously telling us that it's worth our time to be looking for short opportunities. If we had a thick blue dot, say one of these, then it would mean probability to the upside. It would mean that we would be looking to go long. Again, doesn't mean we're just going to press buy whatever the price is now. We're going to be looking for decent places to do that. But at least we have permission to look to go long because we have a thick blue dot confirmed upwards climate, probability to the upside. If it's a thin dot, which are kind of harder to see, but I guess that's the point. If it's a thin dot of either color, that would tell us we don't have probabilities either way. And if we don't have probabilities either way, we don't want to be involved. There is no point placing trades when we don't have at least some form of probabilities on our side. It will waste our time and probably result in more likelihood of losing money, which we don't want to do. So we look at our auto climate first to basically give us permission. Are we going to look to go short? Are we going to look to go long? Or are we going to change markets and look at something different entirely? So in this case, we have a thick red dot, confirmed downwards climate, probability to the downside, meaning we're going to look to go short. Again, doesn't mean we're going to go short straight away. It just means we're going to look to do that. So what we're going to do is we're going to put our UFOs on our right-hand side. I should show that. Okay, so that's interesting. Right, so I'm just going to explain this. So the first thing that we do, as we said, is look at our auto climate and answer the question, should we be long, short, or do nothing? That's question number one. Question number two, which is answered on the right-hand side of the chart. So we've got our auto climate on the left-hand side. That helps answer question number one. On the right-hand side is where we have our auto UFOs. And that helps us answer question number two, which is, if long, where? If short, where? Short, where? Just because we have probability to the upside doesn't mean we just press buy. We want to make sure that we get in areas where we can keep our risk as low as possible, we can increase our reward as high as possible, and that we can improve our probabilities. Same if we're short, we don't just press sell at whatever the price is. We're going to try and get in an area which has got those things in our favor. Risk managed, reward or potential profit is good, and probabilities are high. So if we're going to go long, where are we going to do that? If we're going to go short, where are we going to do that? That's question number two. We answer that by this one on the right hand side, which is our auto UFOs. So just for those of you that may not know, again, I don't know, you guys let me know in the chat box if you've been using UFOs for ages and you already know this. If not, maybe for the recording as well, for anyone that doesn't understand them, I'll just explain very quickly what this means. So the auto UFOs, UFO stands for unfilled order. Basically what it means is the app is looking through the markets to find big stacks of buy orders and big stacks of sell orders. Now, why is that helpful? Because if we have big stacks of buy orders, say, for example, this one here, the green UFOs are our buy orders. We have big stacks of buy orders in the markets. Then the likelihood is when lots of buying comes into the market, then the market goes upwards. Not always. If you've got lots of selling, of course, then that's going to counteract that. But if we have an idea of where there's going to be big stacks of buy orders unfilled that are waiting to be triggered, waiting to come in, waiting to buy, then it gives us an idea of where we may have probability to get in. So if I just squidge this down a little bit so we see the numbers, what the Auto UFO app is doing is highlighting for us and showing us the price range as to where those buy orders are likely to be. So again, it gives us specific numbers as to where we should be really looking to get in or out if we were buying. If we're selling, then we look for our red UFOs. And again, they highlight to us on the right-hand side the numbers, what of the price range as to where those sell orders are. There's loads of sell orders that are going to come into a market. They're likely to push price down. So we use our auto UFOs to help us figure out where we're going to buy, where we're going to sell. Now, it's not just as simple as that. There is one extra layer that we put in here, and we put this in here for a reason, which in this case actually rules out an opportunity. But I'll explain why. We have our EMA, our 9-period EMA. That's what we've got on this chart, which is on the left-hand side again. So we're kind of flicking between our timeframes here to combine the probabilities in the right way. So on our bigger timeframe, so in this case, our daily chart, we have an EMA, a 9-period EMA. EMA stands for exponential moving average. Moving average, clue is in the name. It moves as an average of price. It's exponential because it puts more weight on the most recent candles as opposed to evenly throughout it. So with this EMA, why is that important? Why is that even something we're talking about? We use it because loads of people use the EMA. Across the world, in pretty much any platform that you have, you've got access to EMAs for free. You don't need to download it. You don't need to pay for it. It's just there. It's on your platform. So people use EMAs, people use moving averages to help them get in and out of trades. A common practice would be that if price is below the EMA, so say here we've got price there and we had the EMA above it. So if price is below the EMA, that if it comes back and touches the EMA, which it did here, then people sell. If price is above the EMA, so let's take here. So here we have prices there and the EMA is below it. So in theory, what a lot of people do is if price comes down and hits the EMA, they start buying. So they're using the EMA, they're using that average price to give them an entry point. And that's not just retail traders, it will be fund managers as well will use similar techniques. So what that means is that at the EMA price, for different reasons, you might have sell orders. Because at the moment, price is below the EMA, meaning if it comes back and hits the EMA, you're likely to have sell orders. So if we combine sell orders from our UFOs, which are sell orders that are there anyway, that are being picked up by the app, with sell orders that are coming in from our EMA, from people that are trading in a different way, doing something else, also adding sell orders at the same time, we have more probability of price going down. The more sell orders that come in, the more probability it is that they beat whatever buy orders are there and push price down. So we want those two numbers to line up. We want our EMA value to line up within a UFO. And at the moment, our EMA value, which is 1.5460, which is around about here-ish, maybe a little bit lower. At the moment, there's no UFOs anywhere near that. So these two lines, these two components are not lining up. We don't have two lots of probability going in our favor. You may be somebody that says, no bother, I'm going to use my auto climate and then use, which is a free app, and then use my moving averages, which is a free app. And that's all I'm going to use. I won't use UFOs. So I'll just get in at the EMA value. Fine. That's fine. You can do that. You could be somebody that says, okay, I'm going to use my auto climate to help me figure out if I'm long or short. And then I'm just going to take the closest UFO. So if I'm going to go short, I'll take the closest red UFO. If I'm going to go long, I'll take the closest green UFO. That's also a perfectly valid way of thinking. Why do we add in this third element and have to have both of these things work together? Because it adds more likelihood, it adds more probability on our side, which means we're less likely to lose. So depending on what you're like as a trader will depend on how comfortable you are to lose and whether or not you'd rather have more trading opportunities but less probability, or less trading opportunities but more probability. Neither one of those are right or wrong. It will result in different things. It may even result in the same thing. Let's say you have 10 opportunities that have high probability. That might make you just as much money as 100 opportunities that have low probability. It just, either way, it depends on whether or not you're patient or impatient, whether or not you are willing to see opportunities that you don't take because they don't quite line up and then maybe see them go in your favor, or whether or not you're okay to just place trades knowing that you have a higher probability that they lose rather than they win. So again, all of those things are subjective. For us, with our methodology, we are combining these to add the probabilities, which will decrease the opportunities but increase the likelihood that they work out. So hopefully that makes sense. So again, let me know in the chat, guys, if you have questions, if what I'm saying doesn't make sense, if you have a particular currency pair that you want to look at, just let me know. Otherwise, I'm going to just keep looking for opportunities and keep explaining my way through them so that we can have a look and see what we want to do. So we looked here at the Euro Aussie. Now, first things first, actually, I should say, one healthy practice would be to use the FX Street economic calendar. So you can come here and filter by high impact news, that's what we do, and filter by this week, so that we can have an idea now as to whether or not we are likely to have news that will come out that could impact these currencies. We don't use it to actually make the decision on long or short. We have technology that helps us do that, where we can be as objective as possible rather than subjectively interpret the news. But it might be helpful to understand that, for example, today, some news coming out on the Canadian dollar that could have high impact, and on the US dollar as well. It could be helpful to know that on Thursday we have multiple things coming out that could have a high impact on the euro. Again, that doesn't necessarily mean that you say, right, I'm going to avoid it. It might mean that you limit your risk a little bit more. It might mean that you have less trades. Maybe you say, okay, if there's going to be euro news coming out tomorrow, well, maybe I only have one trade that has the euro in it, and then I'll trade other things that are not related to the euro, rather than trade the euro yen, euro dollar, euro pound, euro Swiss, whatever it is, and then end up placing a lot of trades on a currency that may incur a lot of volatility, and you could be wrong on all of them, could be right on all of them. But again, we want to limit our risk here. So a healthy practice to do this. There's nothing coming up where it's one particular currency too many times. So I'm just going to look through it as I would normally, but bear those things in mind. So we have a look at the Euro Aussie. Let's have a look now at the Euro New Zealand. I would imagine it's going to be very similar here. So just to say, Euro New Zealand, we have a near sensible short alert and we have a red box. So that is showing us what we need to look at to make it worth our time to come and look at our chart. So I would imagine, of course, these two things are very, very correlated. I would imagine we'll have the same situation, but let's have a look. Okay, we have the same or similar situation. It's not as extreme as the last one, but here again we have thick red dot, confirmed probability to the downside, look to go short. Our EMA value is 1.660, obviously 0.05, so just about here. So ideally we would want a red UFO here. At the moment our closest red UFO is up there. So at the moment those two things aren't lining up, so we move on to another opportunity. Now, I know I went through that quickly. For those of you that this might be the first time that you're looking at this, hopefully that makes sense as to why we did that. We eliminated it based on, let's go back here. We eliminated it based on, let me just put our UFOs back on, based on the fact that we didn't have two sets of probabilities lining up. We want the EMA value to be inside the UFO, and in this case it wasn't, it was outside the UFO, so we eliminate the opportunity. So we'll move on. The next one I just saw there would be the Aussie New Zealand. In this case, we would be looking at a near sensible long. And again, we have a blue box there, which is helpful. So we'll look at the Aussie New Zealand and see what we have there. So Aussie New Zealand, again, I'm just clicking the top one. If you're trading with different platforms, different brokers, then you can pick obviously from this list so that you're seeing the data that's more relevant to the broker you're going to be using. So we have the similar situation here. So just to explain very quickly. Thick blue dot, okay, confirmed upwards climate, probability to the upside, look to go long. That's question number 1 answered. Question number 2 would be, where do we do that? The answer that we give is where we have the EMA being enveloped by a UFO. Now, the EMA, which is 1.0730, is here. And as you can see, no UFOs. As I said before, when you combine these different elements for probability, you're going to end up with less opportunities. If you just place the closest UFO, it wouldn't matter what the EMA was, you just place that. If you ignored UFOs and you just looked at the EMA, it wouldn't matter, you just place that. If you were using Fibonacci retracements or some form of breakout, or you were using visual techniques to find entry points, again, then you may see opportunities where we would eliminate them. Right or wrong, again, the more variables you need to have here, the higher your probability, usually, which means more likely to work out, but the less opportunities you have. So again, you kind of exchange one for the other a lot of the time. So again, in this situation, Australian, New Zealand dollar on these timeframes would not work out in our favor. So we'll move on, have a look at another one. So we have the Swiss yen. That's what we have here. That's the last one on these daily climates that we can see. That will work out for us to even make it worth looking at. And that's because it's the last one that has near sensible next to it. We don't want to look at near hopefuls. Hopeful is not how we should be trading, right? We should be trading sensibly, as objectively and mechanically as possible. So we have near sensible long. And again, we have that thick blue box. So great, let's have a look at the Swiss yen. So again, the good thing about the scanners is that we're not looking through each of these one by one, just looking through a watch list of 30, 40 different currency pairs. We are just looking at the scans, and it's eliminating a lot of the effort for us. So let's have a look here. So what we have here is, again, we have a thick blue dot, confirmed upwards climate, probability to the upside. Question 1 answered. Question 2 is, if we're going to go long, where do we go long? Or if we're going to go short, where do we go short? In this case, if we would be looking to go long, where are we going to do that? Now, ideally, what we want is this EMA value to be enveloped by a UFO. So we want that number to be inside one of these, in between these ranges. Now, at the moment, what we have is an EMA value, which is about here. And again, UFO below it, so they're not combined. Now, of course, the EMA is a moving average, right? So it moves with price. So as price moves down, if price moves down, then the moving average, which is a different color for that, is also likely to move down. Now, are they likely to move down at the same rate so that they meet at the UFO at the same time? That's harder to call. You could put an alert on. So rather than put a trade on that might not work out, let's use a different color again, you might put an alert on it, say this price. So that if price does hit this line, you have a look at where the EMA value is and see whether or not they're going to be lining up. And again, if they don't, no worries, you just look at a different opportunity, which is what we're going to do now. We're going to come back to our trade station and we're going to look for different opportunities. So let's switch it up a little bit and let's look at our 240-minute climates. So the top one here is the Swiss, let's use a different color, is the Swiss yen, again, which is what we were just looking at there, but we're changing timeframes. Here are the 240-minute climates. So this will be swing trading, but just slightly smaller timeframes, meaning that the trades will last maybe more like a couple of hours to a couple of days, rather than a couple of days to a couple of weeks. So we have a near sensible short, and we have that thick box there. So let's go and take a look at that. Swiss yen, same currency pair, but different timeframes. So we're going to go 240-minute on the left-hand side, which means we're going to go 21-minute on the right-hand side. Now, you might think that sounds a bit strange that we would be doing things that way. There is a reason for it. We use these slightly off timeframes on the smaller timeframes for a reason. They are Fibonacci numbers, and those tend to be used by computing systems. Who uses computing systems to help them trade? Normally, that's going to be your big boys, big banks and institutions. So again, we have the same or lack of opportunity here because let's just put, I don't know where my auto climate went there, so let's just put that back on. There we go. Oh no, I have to. Let's get rid of one of them. Okay, so we have a thick red dot there, which is a confirmed downwards climate, probability to the downside. Just look there. Swiss franc Japanese 4 hour. I thought we had a long opportunity there. Oh no, it is short. Okay, brilliant. So that means that we are looking for a UFO on the right hand side, a sell UFO that envelops our EMA value. Again, we have a bit of a problem here. The EMA value is pretty much exactly where current price is. It's right here. There are no sell UFOs around there. Closest one is here. They don't line up. Again, you could be somebody that says, right, I'm just going to take that UFO. I'm going to ignore the EMA and I'm just going to take that UFO as it is. No problem. You could be somebody that says, great, I trade at EMA values and we're at the EMA value. So I'm just going to go short right now at market. That's also fine too. Again, for us, we want to combine those two things to add probability. Sell orders plus sell orders gives us a lot more probability of a continuous move down. Just one stack of sell orders has obviously less probability of working out against whatever buy orders may be in the market. So no problem. Again, we'll just move on to the next opportunity. So we'll have a look here at the Euro New Zealand on a 240-minute chart. That's a short opportunity. So let's have a look there. Just to show you, it's this one here. That's what we're looking at. So near sensible short on the Euro New Zealand. Let's take a look. Again, we're using our slightly smaller time frames here. So Euro New Zealand, again, make sure you do that on both charts. Otherwise you might miss opportunities there. Okay, it may be here that we have an opportunity. Yes, we do. Now, interestingly, we are currently within this this UFO. So let me just explain. We have a thick red dot, confirmed downwards climate, probability to the downside, which means we need to look to go short. That's answered question number one. First question we should ever ask ourselves when we trade. Should I go long or short or do nothing? In this case, we should be looking to go short. Now, we want to go short at an area where we have an EMA value enveloped by our UFOs. So in this case, if we're looking to go short, we're looking for red UFOs. Now, the EMA value at the current time is 1.6602, which is actually just between these UFOs. So you might be thinking, oh God, we're not gonna do this one because it's just in between UFOs and not quite lining up. Don't worry, with this one, we'll actually take it and I'll explain why. It is a moving average, right? It moves with price. So if price was to move up and hit this UFO, then the EMA value, which is currently here, is likely to move up a couple of pips and therefore be enveloped. We might be wrong on that, but I think it's a very likely thing to happen. And so what we're going to do is focus on this UFO as our entry UFO. This is where we're going to be looking to take a short opportunity. So let me just get our order panel here, and that will help as we place this trade. So you might be thinking, well, hold on, there's a UFO right now that we're in the middle of. Again, this UFO that we're right in the middle of is not enveloping the EMA, so it's not something that we want to be thinking about. We want to be thinking about this one here. Now, it may end up being that we take a slightly bigger area, and I'll explain that when we get to it. So we use our UFOs now to, again, help us with the numbers. Rather than make it up, rather than just add numbers based on what we fancy, we are using the UFOs to give us the reference value. So as we're going short here, the UFO reference value is 1.66065, right? That's the lowest range, or the lowest price within that range where we have sell orders being picked up by the app. So we're just going to round that down just to the closest pip, which is 1.6606. So that will be our entry. So if I just click sell here, and I'm going to put here 1.66, oh, there we go, 1.6606. So that will be the entry. Weirdly, our UFO just disappeared there. Let's put them back on. So 1.6606, that's the entry. Now, our stop, we would use this top number. So again, the UFO is showing us a range of price as to where there are sell orders. So 1.6606 is where they start, and 1.6624 is where they end, before a new lot starts again a few pips above. So 1.6624, 1. Obviously, 1 is our percentage of a pip there. So we're going to round that up to 1.6625. And then what we're going to do is add a couple of pips for the spread, which makes it 1.6627. And then we're going to add 5 pips for wiggle room. So I'm just going to write this out so we can see that there. So the original number was 1.66241. So we've changed that and rounded it up because it's a buy order. So we're going to round it up to 1.6625. We're going to add a couple of pips, 1.6627. That gives us a little bit of room for the spread. Again, for buy orders, we need to be more conscious of that. And then we want to add a little bit of wiggle room. We want to add a little bit of wiggle room because let's say it hits 1.6628 and then drops. That's going to be annoying. So what that means then, by adding 5 pips, we now have 1.6632, which is within this UFO. Now, why would we want to, in this case, we're going short, then our stop is a buy order. Why would we want to buy out of a position in the middle of sell orders? If it goes through, if price moves through this UFO, hits this UFO, moves through it, it's a lot of those buy orders have been eaten up, and it's now within a new fresh stack of sell orders, which are likely to push it down. So why would we want to get out within that area? Better for us to be more safe and get out outside of that area. So what that means is we are now going to take this reference number, which is 1.66437. So let's do this again. 1.66437. We're going to round it up to 6644. We're going to add a couple of pips for the spread, which is 1.6646, and then we're going to add 5 pips of wiggle room, which is 1.6651. So that will be where we place our stop, 1.6651. So we're just going to come over here and we're going to put that in there, 1.6651. Now, what I like to do, and you guys might like to do this as well, I like to use my Fibonacci retracement lines. I don't use them as they're intended to be used. So if you do use them or you follow people that use them, this won't make sense to you. But I draw them like this. And all I do, if I just come to style, I just tick 0 and 1. So normally you would have, these elements, and you'd have different lines that would be showing on the chart. I'm not looking at those. I'm just using these as a drawing tool to help just highlight an area to make it easier for me to come back later on. And I'm going to just make it red because we're going short. Just like to make that make sense. So there we go. And then I'm going to come to coordinates and I'm just going to type in what my values are. So 6651 is the stop and 6606 is the entry. So now if I click OK, my entry to stop has now been highlighted. So hopefully that makes sense as to why I've done that. It's just to highlight the area of both of those UFOs, showing me exactly what my entry and stop values are on the chart. Which means that as price moves, because as orders are being filled, the UFO would disappear. The UFO shows us unfilled orders. So as the orders get filled, the UFO will disappear. So let's say price moves like that and then moves down. If I don't have highlighted on the chart where my entry and stop would be, I might not have any idea of where I got in or got out. Or it might be more difficult for me to go and find out that information as opposed to just having it there on the chart for me to see. So now we need to think about our targets. If that's our entry and our stop, then where are our targets? Now we're just going to put on our auto UFOs on this chart here on the left, which is going to help us out here a little bit. So let's put our indicator on. Now, why am I doing this? The reason is, we just put that on there. The reason that I'm putting this UFOs on the left-hand side now, because you might be thinking, well, hold on, we've been doing that on the right-hand side. So why are we now using UFOs on the left? The reason for that is because if we're going to go short here, we need to have an objective place to get out. If we're going to sell to enter, we need to know where we're going to get out to make a profit. And again, we don't just make this up based on where we want it to go or where we hope it would go or what's going to help pay our mortgage. It's nothing like that. It's where do we have objective evidence where price would be likely to change against us. So in this case, if we just go here, the closest stack of buy orders on our bigger time frame is at 1.639987. That's the closest stack of buy orders. So if we've got a downwards climate, that based on stats, and we'll come back to that another day, based on stats has a little bit of room to the downside, then we want to be able to capture as much of a move to the downside as possible. The most likely place for that move to stop is where it hits a big stack of buy orders. So we want to take this top number, which is 1.63987, and we're just going to round it up to 1.6399 and add a couple of pips. So 1.6401, that's going to be our target. This is our final target. I'll talk to you in a minute about our safety target. We'll put that on in a minute. So 1.6401, that's going to be our final target. So with this in mind now, we can then put this on our chart as well. So I use a horizontal ray. Again, just put it on the chart. I'll make it green because it's a target. We'll come to coordinates and we'll just type in what that number would be. So 6401. So it's quite a way away, and it's intended to be quite a way away so that we can capture as much of the move as possible. But it means that we've now got it on the chart. We can see visually where those orders are. So now we just need to figure out our position size. So for me, I'm going to make this very easy. I'm going to assume, so we're going to have two targets with a total risk of $100. I've done that just because it's a nice round, easy number. Of course, you might have a total risk of $60 or $2 or $3,000 or $10,000, whatever. It's going to be up to you to decide what that total risk is. So if we have two targets with a total risk of $100, then that means each target, so let's say target 1 and target 2, each target needs to be risking $50. That's what we want our risk to be. That's because if you put those two together, it makes $100. Now, we have different targets in different places. So our safety target, we'll do that in a minute, will make a lot less if we're right than our final target if we're right. But we're still risking the same on either one. And we do that for a reason. So I'll explain that in a second. So in this case, if I want to risk $50, all I have to do is come here and type into quantity $50. It will then figure out the amount of lots that needs to be for me. I don't need to do the maths, which is good for me. So I'm just going to double check that that is where it needs to be. 1.6606 is our entry, 1.6651 is our stop, and our target at 1.6401. I'm going to check that I'm risking $50, and then I'm just going to click sell. That's not going to go in on the chart, and it's going to go into whatever broker that you're linked to will then send that to your brokerage firm for that trade to be in. Cool. So that's the final target there that we've got. Now, we also need to have a safety target. So I'm just going to put in the exact same thing. So we have our entry and stop is in the exact same area. So 6606 was our entry, and 6651, it's remembered it there, is our stop. Now, the entry and stop is exactly the same because it's still the same area where we have probabilities of sell orders coming in to push price down. But where are we going to take our safety target? Now, safety target, hopefully, again, clue is in the name there with safety target, is that we have it to be safe. So what we do is we will calculate the difference between here and here. And again, TradingView does this for us. And we will project that same distance again towards ourselves in profit. So it means that we may take profit round about here. So it's a 1-to-1 difference. Now, the reason we do that is because let's say that we've risked $50, we've risked $100. And it goes somewhat in our favor. So price goes into our UFO and moves out a little bit. Not all the way down to our final target, that's less likely to happen, but it moves a little bit. If it moves a little bit, 1-to-1 away, then we've just banked $50, which means our risk is now $50. We've kept $50, we're now in profit of $50. Let's say it hits our target and then it moves against us. Well, we made $50 and then we lost $50. So overall, we break even. Nothing bad happened. Nothing good happened. It almost negated that it happened at all. But it means that we are safer. If price goes somewhat in our favor, but not all the way in our favor, we still don't lose. If we just had our final target and we just risked $100 here, and price went maybe 3-to-1 away, 4-to-1 away, but it didn't quite hit our target. Sometimes that happens. New stack of buy orders comes in, goes against us, moves right against us here, we just lose $100, even though it went in our favor, because it didn't quite hit our profit target. Now, of course, there are trailing stops and different risk management techniques that you can use with that. It's a bit more advanced, but that's also fine to do. But one of the easier ways of doing this is to simply have a safety target, where if it hits 1-to-1 away, we bank $50. And then if from that point, let's say it did go all the way down here, but not quite hit the target and come back, and we lose $50 here, no problem. We didn't win, we didn't lose. Rather than see it go in our favor and lose, we'd rather see it go in our favor and then maybe break even. Ideally, what we want is to see it go in our favor and make money, right? We want it to hit our final target, but it may not, hence why we put in our safety target. Again, very easy way of doing this. We just click this take profit bit. See, this says 45 pips. We can just put 45 in there. So it would automatically work out for us what the difference is between our entry and stop, and all we need to do is copy that over, and it will figure out what the target needs to be, rather than us doing the maths or putting it into an Excel spreadsheet or anything like that. We just do it on TradingView and it does it for us. Again, saves us time, makes it easier. So if we risk $50 on the first one, we risk $50 on the second one. Let's draw it on our chart as well. Horizontal ray, we'll put that on there. And the number that TradingView so kindly gave us was 6561. There we go. So now we have our safety target. We're going to click sell. We have $100 total risk between our entry and stop. We have $50 being risked for our first target. If we're right, we'll take $50 profit there. And then we have another $50 at risk waiting to go to our final target. The final target is, by the looks of it, just eyeballing that, maybe 4-1 away, which means overall the way this works is, let's say we're right and price does this. So price comes in and then it goes off, it hits our safety target, might bounce around a little bit, comes back down and hits our final target. Great. So what happens there is target 1 made $50, target 2 made 4-1. I know we had an initial risk of $100, so you might think, oh great, that made $400. But bear in mind, target 2 only had $50 risk on it. So it's 4-1 of 450, 4-1 of 50. So it would make $200. Overall, the profit, if we were to be right on this trade, would be $250. So overall, we've risked $100 to make $250. If we just had our final target, that's, I'm again eyeballing that, that was 4-1 away. If we just had our final target and we didn't have our safety target, then it could be that we risked 100 to make 400. So the overall profit would be higher. But what we risk in that is price going somewhat in our favor, but not all the way in our favor, and resulting in more losses. Normally, and again, it's up to you guys to figure out whether you do use the safety target or not, or whether you trail your stops, or where you put your targets. But bear in mind that normally the way the human psyche works is we would rather be right more often than make more. So what that means is, let's say doing it this way with our safety target means that we break even 30% of the time. And let's say we're just completely wrong, where price goes completely through 30% of the time, and then the remaining third of the time, which would actually be 40% of the time, but you know what I mean, a third. The remaining third of the time we hit our final target. Well, the third of the time that we hit our final target, our overall profit is reduced because we took money off the table a bit early. But the third of the time where price went somewhat in our favor and then against us, if we didn't have our safety target, we'd have lost that. So what that means, I'm just going to play that out, these numbers so you can see it visually. So let's say 33% of the time you break even. 33% you win at a reduced rate because you've taken our safety target, and 33% of the time you just lose. Which means you only need to be okay with losing 33% of the time. Only a third of the time is when you lose money. A third of the time you win, and a third of the time you break even. Now, let's say you didn't have a safety target. So all of those ones that were break even, that 33% that was break even, those now become losses because you didn't take any profits to lock in profit to make that a break even. Price went somewhat in your favor and then went against you and you lost. So 33% becomes a loss. The other 33%, that was already a loss. So you win 33% of the time. You win more at a higher rate, but now you've got to be okay with losing 66% of the time. Would you rather be okay with losing a third of the time or be okay with losing 2/3 of the time? And I'm asking that as a question that's a genuinely good thing for you guys to think about, because We're all going to have different answers to that. Some people will say, I'm fine to take those losses if it means that I make more when I'm right. And overall, maybe that balances out a bigger account. Some people might say, I don't even want to be wrong a third of the time. And obviously I made up these numbers just to be, just make the point, right? It could be 25% and 50% and another 25 or whatever the numbers are. But hopefully you get the point that in adding the safety target, we are reducing how many times we need to lose. We are also reducing the amount of money that we make when we're right, fully, but we exchange that for less losers to make it psychologically easier for us to get up the next morning and place trades again. If you lose 2/3 of the time, out of 100 trades, you've lost 66 times, 67 times. So let's say you're right a couple of times, but then you're wrong 10 times in a row, and then you're right a couple of times. Are you okay to be wrong that amount of times in a row? Is that gonna affect you with being comfortable placing more trades if you've had to take a few losers in a row? Versus if you're wrong a third of the time or a quarter of the time or less of the time. You might be frustrated not seeing your profits be as high as they could be, but you're not losing as much, which makes it easier for you to put on a trade knowing that you have a 2/3 probability that it either wins or doesn't do anything. Doesn't make you money, doesn't lose you money. You're less likely to lose, which is psychologically easier to continue to place the trades and continue to do the methodology. So that's why we have safety targets. I'm just going to put the UFOs on there so we see it a little bit better. That's why we have the safety target. Again, all of this is ultimately up to you guys. You could be saying, I'm not going to use the EMA, or I am going to use the EMA and not the UFOs, or I'm not going to use either of them. I'm going to use the auto climate, and then I'm going to use Fibonacci retracements, or I'm going to use moving average crossovers, or I'm going to use whatever other technique I've learned. You could be following us with everything on the methodology, EMAs, UFOs, auto climate, disagree when it comes to the targets. That's also fine. What's most important for anyone trading is that we understand that it's okay. Sorry, excuse me. It's okay to be subjective. It's okay to be subjective as long as you then apply that objectively. What I mean by that, it's if you've decided that you are the type of person that would rather just take one target further away, accepting that that might increase the amount of times that you lose, but when you're right, you make more, and that suits you subjectively, that's going to be easier for you to do than to follow a methodology that doesn't make sense to you. So you've been subjective to make that decision, but this is where it needs to become objective. You then need to make sure you do that every time. Don't sometimes place a safety target and sometimes place a final target based on random how you feel that day. That's too subjective. You can subjectively interpret the methodology to then make it an objective plan, where every time you place a trade, you either have safety and final target or just one of them, or whatever you do with your targets, but it's consistent. So every time you are consistently doing what subjectively makes the most sense to you. Again, don't sometimes use the EMA and sometimes don't. That's inconsistent. Inconsistent action often leads to inconsistent results. So if you're going to be somebody that says, you know what, I don't need it to be that probable, I'm going to take the EMA out of the equation and I'm just going to use UFOs for my entries, for example. Acknowledge that means you will have more trading opportunities, but likelihood is less of them will work out than if you did add in that extra variable of the EMA. But if you're going to pick that, fine, pick it, but keep to it. Make sure you don't ever use the EMA, rather than maybe use it sometimes. Or place some of your own trades where you do use the EMA, and place trades where you follow someone else where you don't, and place trades where you're copying somebody else's trades and you do something different. Be consistent, whatever it is. So use the methodology. Hopefully I've explained it well enough to understand what we're doing here. We use scanners to help us figure out where it's worth our time. You don't have to use scanners. You can just look through each of the markets that you want to trade. We look at auto climate on the bigger of the two time frames. In this case, it was a 4-hour that we used for the bigger time frame. We use auto climate to tell us, should we be looking to go short because it's a thick red dot? Should we be looking to go long if it's a thick blue dot? Or should we keep away if it's a thin dot? We use AutoClimate to help us do that. Answer that first question. Should I be looking to go long, short, or do nothing? In this case, we had a thick red dot. We're looking to go short. That's what we do. We then have question number 2, which tells us, or which asks us, if we're going to go short, where? If we're going to go long, where? So we come and we use our AutoUFOs. We use this app to help us identify where we have stacks of buy orders and where we have stacks of sell orders that are likely to change the direction of price. If we have a stack of sell orders, they're likely to push price down. If we have a stack of buy orders, they're likely to push price up. And then we use our EMA value on the bigger of the 2 timeframes, so coming back to the bigger time frame again, to combine with our UFOs on the smaller time frame to add in extra orders. If sell orders are coming in at the UFO and they're coming in at the EMA, more sell orders are coming in. We want to be selling when there's lots of selling, because it's likely to win against the buyers and push it down. We want to be buying, if this was the reverse, we want to be buying where there's lots of buying, because it's likely to win against the sell orders and push price up. So we're adding in those variables there to then help us figure out where we're going to buy or sell. We then use the reference numbers that are given to us by the UFOs, which in this case I've added drawing tools, so it was a little bit harder to see, but we had that as our top reference and we had that as our bottom reference. So we use the numbers that the UFOs give us objectively to then help us figure out our entries, our stops. We have our safety target at 1 to 1 away all the time. So whatever the distance is between entry and stop, that is projected towards our profit, 1 to 1. And then our final target is based off of our AutoUFOs on the bigger time frame. Again, showing us where we have the greatest probability of a continuous move. The bigger the time frame, the bigger the stack of orders. So a sell climate on a 4-hour chart is likely to push through stacks of buy orders on a smaller time frame, because the climate is on a bigger time frame. So you have selling pressure on a bigger time frame that is more likely to beat buying pressure on a smaller time frame. What could compete with our climate is stacks of orders on the same time frame. And that's why we use that as our final target. Again, it's subjective. It's based on where we have probabilities of price changing direction. We take safety target and final target, meaning overall, if we're right on both of those things, we profit somewhere in the middle. If we just hit safety target and then our stop, we break even. We could be wrong entirely, in which case we just lose, but we're less likely to because of our safety target. So that is, in a nutshell, how we do the methodology start to finish. There are, of course, extra variables and extra things that you can layer into this if you want to add more probabilities, greater probabilities. You can also take things away if you'd rather have more opportunities but less probability. Again, hopefully I'm just making the point here that ultimately it's up to you guys to hear people that are trading, hear their methodologies, and understand which one makes the most sense to you, one that you're most likely to actually enact regularly, and then do that regularly. Be consistent in the way that you apply it. Track what you do, backtest what you do, and over time your trading will just get better and better, and your understanding of it will get better and better. So that's me done for the day. That is the end of the session. We had, as we saw here, an opportunity. It was the Euro New Zealand dollar. We got in on a 21-minute time frame. The next time we come back to Nailing FX on FX Street, we'll take a look at that trade and see what happened. Did we lose? Did we break even? Did we make money? How did that go? Did we even trigger? Would we have cancelled the trade if certain variables changed? So we'll come back and reflect on that on the next session. In the meantime, again, you've got the tradewithufos.com/Becky. If you put in your name and email address there, get yourself a free membership. Then you can download the apps and things like that if you want to. And then you can ask questions in a public space once you're logged in, where other people can see the answer, so we can all learn from each other and we can all get better together. So see you guys next time. Again, any questions, you guys can email me, or you can use this if you need help with anything. You can use this link or email me, becky@tradewithufos.com. Otherwise, I will love you and leave you guys. Have a good week, and I will see you next time. Take care. Bye bye.